University of Mumbai, Mcom Sem 4, Financial Planning, Question Bank Solution, Part 6. Question number 6 is explain various income tax saving schemes. While tax planning is crucial, tax saving schemes are also essential. We can save tax and earn return with the best tax saving schemes in India. This will ensure we do not pay more taxes and save tax in India along with year-long returns on tax-saving investment. Okay, so paying taxes is a crucial. Okay, but tax saving is also important, and government of India has introduced with a various scheme where people can develop the habit of saving, covering their life, and also they can get a good returns on tax saving investment. So there are various number of tax saving scheme uh, like unit link insurance plan. So unit link insurance plan is one of the most important investment plan in India. It ensures that one family is financially balanced in case of the event of death. By purchasing a life insurance policy, the taxpayer can avail of the benefit under Income Tax Act. Okay, so this unit link is a very good plan where the people will get their life cover as per as it is an investment, and it give you the opportunity to invest in the equity market so that you get a good returns in the future. Because see, in the investment plans of a regular insurance policy give you the fixed returns, and they are not much. Okay, but when you invest your money in a with a equity funds, the rate or the returns which you are going to get in the future will be high, because the money will be invested in such a companies which are very safe or A rated, so that there are very low risk that your money will your whatever amount you have invested will reduce, but there is chances that you will get a good return. So under unit link insurance policy under section 80C of the Income Tax Act 1961, the premium paid toward the purchase of a life insurance policy qualifies for deduction up to 1.5 lakhs. Furthermore, as per section 1010D, income on the maturity of the policy is tax free. The income is tax free if the premium is not more than 10% of the sum assured. In the case wherein the income goes to the nominee of the person insured, the same remain as a tax assumption in the hand of the nominee. Okay, so under section 80C, you get a tax deduction of 1.5 lakh, and when you get your maturity amount in your hand under section 80 in the section 1010D, you are going to get tax free return. Okay, but you will get this tax free return only when the premium is not more than 10% of the sum assured. Okay, so next plan is equity linked savings scheme. Now equity linked savings schemes are mutual fund investment scheme that invest a large part of the portfolio in equity. Furthermore, the fund has a mandatory lock-in period of 3 years, which is the shortest among all the investment products. Investment in equity linked savings scheme qualify for deduction under section 80C of the Income Tax Act up to the maximum of rupees 1.5 lakh, but lump sum investment and the amount investment or systematic investment plan qualify for the deduction. Since equity link insurance equity link savings scheme fund invest a large amount in equity, there is always some of inherent risk. Okay, so here the equity link mutual fund, you have a tax deduction of 1.5 lakh under the section 80C. The locking period is 3 years, and you can save your tax, but the amount invested here is in the equity, and the whatever return you are going to get, it will be as per as the market rate, so it has some risk carry with it. Okay, then next is public provident fund, that is PPF. So public provident fund has always been a popular tax saving scheme among the taxpayer. One of the major reasons for this popularity is the fact that public provident fund falls under the category of tax status. You can open your public property fund account with a bank or a post office. Taxpayer can claim a deduction under 80C of the Income Tax Act for the amount investment by them during the financial year. The maximum amount eligible for deduction is 1.5 lakhs. Since PPF falls under the exempted category, the interest and maturity amount are exempted from tax. So whatever returns we are going to get after the locking period, it is also exempted from tax. So PPF account comes with a lock-in period of 15 years and it allows the investment the below option at the end of the maturity period. Withdrawal of proceed from the account continue for another 5 years. Okay, so you can also continue your locking period is 15 years, but even if you want, you can continue your PPF account for another 5 years. Okay, so this is also the very good and very popular among the people to invest under this tax saving scheme. Then next is Sukanya Samriddhi Yojana. This is also a very good initiative taken by the government of India to protect girl child. Okay, the slogan of this is Beti Bachao Beti Padhao campaign. Okay, so another tax saving investment option in Sukanya Samriddhi Yojana. It is a small deposit scheme which is particularly designed for a girl child. The plan is launched as a part of a Beti Bachao Beti Padhao campaign. The plan currently offers an interest rate of 7.6% and provide the benefit of tax assumption. As one of the best tax saving investment, the tax benefit offered under Sukanya Samriddhi Yojana are: first, the investment made in Sukanya Samriddhi Yojana are eligible for tax exemption to maximum limit of rupees 1.5 lakhs under section 80C of the IT Act. The interest occur again Sukanya Samriddhi Yojana account get compounded annually is also eligible for tax exemption. The maturity proceeds and withdrawal amount are also tax exempted. One can open a Sukanya Samriddhi Yojana after the birth of a child till she turns 10. The scheme remains operative for 21 years from the date of opening the account till the girl get married after she turns 18 years of age. Currently, Sukanya Samriddhi Yojana offers the highest tax-free return of 7.6%. As a long-term investment option, it is also provide the benefit of compounding. So this is a very good initiative taken by the government of India. This is for the girl child, and once the girl is born, their parent can avail this scheme till she turns 10. The scheme remains operative for 21 years for the date of opening, and till the girl get married, and the limit for it is 18 year of age. So girl should be 18 year of age. So current, and it has a highest interest tax free interest rate, that is 7.5, and it has also one more benefit, that is a compounding interest rate. So this is a very good plan. Sukriti Samriddhi Yojana offer easy of investment to investor. Moreover, the cost of investment is also very affordable, as one can make a minimum investment of rupees 250, this amount of earlier of rupees 1000, and can invest up to maximum of rupees 1.5 lakh in the financial year. Okay, so minimum it is 250, maximum 1.5 lakh in a financial year. As a great tax saving investment option, the plan ensures the safety of investment and secure the future of a girl child. Next investment plan is National Savings Certificate. This is a fixed income tax saving investment scheme which can be opened with any post office. The National Savings Certificate ensures the safety of investment as it is a government initiated savings scheme. The plan is specifically designed to encourage middle income investor to make investment along with the benefit of taxability of income. Similarly to bank, FD and PPF, the National Savings Certificate is also considered as a low risk tax saving investment option. which offer guaranteed return on investment. Okay, so as this is a government plan, okay, it is a government plan, so they have a fixed they give a fixed interest rate on this national savings certificate. The risk of investment is such time is very low as it is a government plan. Okay, and this is why it is initiated, so people develop the habit of saving and also they can avail the tax benefit. As a government initiated tax saving investment scheme, one can claim tax deduction to the maximum limit of rupees 1.5 lakh under section 80C of the IT Act. So whatever till now whatever plan we have discussed is all covered under the section 80C and limit is 1.5 lakh. The interest earned on the certificates is added back to the initial investment and it is eligible for tax assumption. In the second year of investment in the National Savings Certificate account, the investment can claim a tax deduction of the National Savings Certificate invest of that year as well as the interest earned on the previous year. This is because the interest earned is added to the investment and it is compounded annually. So this is the best option they have, because whatever investment you made the earlier year is added to the second year, and you also get a compounded interest rate and which is tax free. So on maturity of this tax saving investment scheme, the individual will receive the entire maturity amount. Since no tax deducted source is applicable on national savings certificate payout, the investors are required to pay the applicable tax on it. Okay, so on the maturity date, when we are paying any premium, you are getting a tax. You are availing the tax deduction. You are taking the advantage of it. But when on the maturity, you have to pay some tax on when you get your maturity amount under the National Savings Certificate. National Pension Scheme. As one of the best tax saving investment schemes, National Pension Scheme helps to provide tax assumption under three different sections as mentioned below. The contribution up to maximum limit of rupees 1.5 lakhs can be claimed for tax assumption under section 80C of the IT Act. Under section 80C D1B, one can get additional deduction up to rupees 50,000 if 10% of the basic salary of individual is contributed by the employer in the national pension scheme, then the amount is not taxed. Okay, so this is the national pension scheme, and which is also the best tax saving investment scheme and very popular. Most of the people avail this type of schemes, and this is also given by the employer to their employee. And this comes with the three different section. One is 80cc where you get the tax deduction of 1.5 lakhs. Then under section 80cc subsection 1b, one can get the additional deduction of rupees 50,000 if 10% of the basic salary of an individual is contributed by the employer in the national pension scheme, then the amount is not taxed. Next scheme of tax is Senior Citizen Savings Scheme. Now, Senior Citizen Savings is a government-backed tax savings scheme, investment scheme, which is specially designed to provide financial safety to senior citizens. Individuals above 60 years are eligible to invest in Senior Citizen Savings Scheme. Under this scheme, the investors are eligible to make a one-time deposit of a minimum of rupees 1 lakh and can invest up to maximum of rupees 15 lakh in case of joint holding and rupees 9 lakh in case of single holding. Thus, the cost of investment in Senior Citizen Savings Scheme is very flexible. Senior Citizen Savings Schemes come with a lock-in period of 5 years. In Senior Citizen Savings Scheme, the interests are payable every quarter. Under this tax saving investment, the deduction of up to rupees 1.5 lakh is applicable for tax deduction under section 80C of the Income Tax Act. As compared to the other tax saving scheme investment, the Senior Citizen Savings Scheme offers the highest interest rate of 7.4% per annum and ensure a guaranteed return to the investor. Besides this, the scheme also allows premature withdrawal in case of any financial emergency. Okay, so this is very good scheme like a Sukanya Samruddhi Yojana scheme where the interest rate is also high. Same type of investment is there. There I think the investment rate is 7.6% and here it is 7.4% for the senior citizen. Here in short you have to keep a certain amount which you will get after maturity, on which the banks will give, means it was a government scheme, so government will give you returns of 7.4% on the amount, and at the end of the 5 year you will get your amount also. So this interest rate is paid after 3 quarters, so the senior citizen can give some amount and they can also get a instant return on their investment, and this is also eligible for the tax purpose also. So this is also one type of best scheme available for the senior citizen. Next is bank fixed deposit scheme. Bank FD are security deposit which is similar to other guarantee return investment option. The only difference in this tenure of investment applicable to bank FD is for 5 years. As a tax saving investment plan, the bank FD offer tax free income. This plan is best suitable for the individual who have low risk appetite and have to save money over a long term period. Bank FD offer guaranteed return on investment to the individual and also ensure the safety of investment as the amount invested get locked in up to the entire tenure. If tax saving investment FD, one can claim up to maximum limit of 1.5 lakh under section 80C of the Income Tax Act. So bank FD is also a very good type of investment. Here the returns are not that much, but still you get a safe returns. Okay, so interest rate of this FDs will be from 5% to 6% as per as current scenario, but you can invest it for the longer period. It is for minimum lock-in period for this type of FD is 5 year. So when you invest a particular amount after one duration, you get a good amount in your hand, and also this is able to give you the tax deduction up to the maximum amount limit is 1.5 lakhs under section 80C of the Income Tax Act. Then you have insurance. As life insurance is considered as a tax saving investment product available in the market, however, it is not advised to the individual to buy a life insurance policy only with the motive of saving tax, as the main objective of this insurance policy is to provide insurance coverage. Along with the benefit of insurance coverage, one can avail benefit of the taxability of income under section 80C and 1010D of the Income Tax Act. In a life insurance policy, the premium paid and maturity proceed toward the policy are tax exempted. Moreover, the return offer under the policy like endowment or money bank are also tax free. Under life insurance policy, one can claim tax exemption up to maximum limit of 1.5 lakhs. Okay, so life insurance is comes with a tax saving investment, but people should not take it as a tax saving because it is also carry a important important assets with it, like it's give you the life cover. Okay, so something happens to you, your family is going to get benefited. Okay, so people should not buy life insurance just for a tax saving purpose, but the main purpose of it is to save your family if something happens to you. Okay, so along with the benefit of insurance coverage, it also give you the tax benefit under a section 80cc and 1010d. It's give you the assumption of a maximum limit of 15 lakhs, and so insurance premium paid and the maturity proceed toward the tax policy are tax exempted. Okay, so these are basically a 9 types of schemes which we have, income tax saving scheme which we have decided. Besides that, we have a additional tax savings investment beyond section 80C. Apart from tax deduction under section 80C, there are various tax saving investment which helps to save on tax. One can get tax benefit on the premium paid toward health insurance and home loan interest. A person can claim a deduction up to rupees 25,000 on the premium paid toward the health insurance under section 80D of the Income Tax Act. Okay, so this is also one of the very good type of tax deduction where you have to take a insurance coverage so that you will be if in type of any types of hospitality, if you are not well and all, then you will get the get a protection against your health means when you will when you will hospitalize and all. And also the when you pay the premium against your health insurance, you will get assumption up to rupees 25,000 on the premium paid toward the health insurance, and it's come under section 80D. So and now and also under section 80 EE of the Income Tax Act, one can deduction up to the 50,000 on home loan interest. Okay, so if you are taking some home loans, okay, so you can also plan your tax by taking your home loans, and you will get the assumption of 50,000 rupees under the section 80 EE. Okay, so home loan also helps in reducing the tax income, as the principal amount of a home loan can be claimed under 80C up to rupees 1.5 lakh, and the interest amount can be claimed as deduction from income from house property. Okay, so these are the various type of income tax saving scheme. So we can conclude that as important earning a decent income from your livelihood, it is also important to save the income whenever and wherever it is possible. Therefore, the Government of India provide income tax saving benefit under various sections to help individuals of different age to attain maximum profit. So this was the answer of question number 6 from the question bank of personal financial planning. For next answer, please prefer subscribing and click on notification bell icon. Thank you.